to the Daily Energy Markets podcast. It is 10:30 UAE time, and it is Monday, the 14th of October, middle of the month, first month of the fourth quarter. And Brent crude oil is trading down this morning in Asian trade, down over $1, down 1.3% at under $78 a barrel again. I tell you, when I was looking at the news yesterday, I would have said the opposite would be happening this morning, and such is the nature of this market. It's so difficult to call. Inflating geopolitical crisis in the Middle East gets trumped, to use a sort of inappropriate word perhaps, by disappointing Chinese stimulus output. So announcements. So these are some of the tug of wars in the oil market at the moment, keeping oil prices relatively subdued, but stable at around $78 a barrel. Let's welcome Omar Najia, Global Head of Derivatives at BB Energy, always kicking us off on a Monday morning. Omar, your thoughts as you search for the direction of travel of this market?
Hi, guys. Morning. So basically, look, we said no Israeli strike. We said lower, and I think oil markets are headed lower. There's no Israeli strike.
When you say no Israeli strike, are you talking about Iran?
Yeah. There's no Israeli strike on Iran. So you basically, we like to be a little bit different here. So on China, we'd look to buy it because everybody's been saying that China's been dead for ages. Then when it popped like 30-40% last week, everybody said, everybody's going to sell it now. And so basically I'd buy even more. And with oil, they said that, this geopolitics is going to drive the price and all the rest of it. And it hasn't. And the reason it hasn't is because everybody was saying Israel is going to strike in 22, 36 hours. No, 48 hours. No, this weekend. No. Any second now, they're just readying the plan. They're getting ready. And we've been saying that Israel is not going to do anything because if it does, this thing is going to go out of control. Why? Because Iran is going to hit them back and hit them back hard. And then you can kiss bye-bye to the US election. You can kiss bye-bye to the S&P. You can kiss bye-bye to the oil market, to the bond market, and oil prices will not be like I read last week from, I don't know who, somebody at Goldman Sachs, like 95 to 96 or something like that. They're going to be at like $500 a barrel. So you can forget about all this stuff that you read about in the mainstream media. So we're bullish the S&P. We think S&P is going up, which means no war. We think oil is going down, which means no war. We think Trump is going to basically win the election. The Wall Street Journal this Saturday is saying it's neck and neck, and Polymarket, the betting site, is showing Trump 10 points ahead. So it's quite amazing. And last week we heard that all the Iranian missiles either fell into the sea or basically, I don't know, some other stuff. Today or on Saturday in the Telegraph, they said, in the UK newspaper, they said that Israel got seriously pummeled, and surprisingly so. So all in all, we think...
Well, there was an interesting article today in I think it was either the FT or the New York Times, or I can't remember where I read it, but actually putting a dollar figure on the damage because all of the insurance claims that went in to housing in Israel. Let's go to, and I'm going to excuse my straight off to the pronunciation of your name, Mriganka Jaipuriar, head of news at APEC, S&P Global Commodity Insights. Don't be insulted. I spent all weekend at a gathering where I had to keep correcting my name, which seems rather simple with two syllables. But nonetheless, it's a beautiful name, and welcome to the show. And thank you for giving us, which was really timely on the aftermath of the press conference in China over the weekend, this sort of ongoing narrative of, is China stimulus enough? What is enough, and what is its impact? Your thoughts and outlook for that?
Yeah, sure. I think we all got very excited last month when China announced probably the single biggest monetary stimulus. And of course, people got excited about oil demand prospects in China because, as you're aware, China's oil demand has been one of the dampening factors for oil prices. I think in China, for China, if you want to just try and understand their stimulus policies, it's important to understand what Xi Jinping's priorities are. And Xi Jinping's, his priority is long-term growth. His priority is investment in high tech. He is not looking at the property sector to drive China's economy anymore. He is not looking at consumption to drive China's economy. His priority is investments in high tech sectors. So from that perspective, the stimulus measures are going to be just about enough to keep China's economy on that sort of growth path of 5%. He is not going to be doing anything too drastic because his plan is not to go back to pushing China to a 10% growth rate. So keeping that in mind, if you look at what that means for the oil markets, what does that mean for commodities, specifically steel? Steel has been suffering in China because of the weak property sector, and so has oil, right? Gas oil demand in China, which was already sort of peaking. The acceleration happened because of a weak property market, and that trend is going to continue. So while we expect some sort of pickup in China's oil demand heading into Q4, mainly from aviation fuel, from LPG. Overall, the outlook for China's oil demand is still quite soft. We are not expecting China's oil demand to be as massive a contributor to Asian oil demand growth as it has been last year. I think in 2023, it accounted for over 80% of China's oil demand growth. This year, we're expecting it to account for about 30%. So that's our view on China's oil demand and overall Chinese economy going forward.
Let's welcome Livia Gallerati, Senior Oil Markets Analyst, Energy Aspects in the UK. Livia, we've heard that Omar, no geopolitical crisis. What are you talking about? China, Marianka is telling us, is still a sort of lame duck despite the stimulus noise. So Livia, your thoughts from Energy Aspects point of view, you guys are usually quite bullish. Love the word 100, I think, but nonetheless, what's your thoughts on the outlook for direction of travel, where it is going to come from? Will it be OPEC plus supply?
So I think there is definitely some agreement in the market on all of these points in terms of the direction of travel for oil prices will definitely be determined by whether there is or there isn't an escalation in the Middle East. China will be very important too. And overall, in terms of supply, what OPEC does and what non-OPEC supply does next year as well. I think these are the three things the market is focused on at the moment.
It would seem that they, just to sort of pick up on that, because I wanted to sort of sharpen your thinking a little bit, that these all exist. Of course, we know that they all exist in the bucket all the time. But ultimately, what is the dominating narrative? We're seeing that prices, that even with the geopolitical headlines in the Middle East, and this was a fairly substantial weekend from my point of view in terms of escalation on the Lebanese-Israeli conflict, or should I say Hezbollah-Israeli conflict, yet oil prices falling this morning because China demand outlook looks weak. So China demand outlook seems to be the trumping issue here. I just wanted to get your sharper thinking on these coexisting trend lines.
Look, for anybody investing in the oil market at the moment, it was very hard to take a long position or a short position really going into the weekend because of both China and the Middle East. Until there is a strike on if there is a strike on physical infrastructure in the Middle East, I think the skew for prices will be to the downside, as Omar was saying. I wouldn't be as confident to ruling out the possibility that there will not be a strike on Iranian oil for infrastructure. I think there is still some possibility that might happen. In terms of Chinese oil demand, I think the market was definitely disappointed by what came out of the meeting on Saturday. There were some expectations of maybe huge numbers coming out of this meeting in terms of fiscal stimulus. That did not happen. I wouldn't say that that's necessarily a sign that the Chinese economy will remain weak or is definitely still weak. Even just their focus on implementing the remaining fiscal stimulus for 2024 should provide a boost to demand of oil products, mostly to the construction sector. Diesel in particular, we're hearing from refiners in the East in China that they plan to increase runs in the coming months on the back of that, which should obviously be a positive thing for oil demand. And even looking at 2025, we are expecting stronger growth from China, stronger growth from the US, and from the emerging markets in general on the back of lower interest rates as well. So I think the demand picture for next year looks a little bit better.
Omar, just picking up on some of the points you made earlier, I mean, in the sense that no strike, no retaliation from Israel to Iran, is that no, zero, nothing, or nothing that jeopardizes oil flow?
No, I think no, nothing. I mean, it's going to be very interesting. So the position is as follows, right? The US and the EU are arming, supporting, financing, diplomatically protecting Israel, the genocide, the invasion of Lebanon, the strikes against everywhere, etc., right? Israel is basically in a position where right now in Lebanon, whatever the news, today or last night, the Hezbollah hit the barracks of Israeli soldiers, killing and injuring up to 110, according to Israeli media, Israeli soldiers while they were having either breakfast or dinner or whatever it was. So, and basically also, there was some very interesting analysis of what was hit by Iran, including some very important radar sites. And today, or again,
you're talking about the hit 2 weeks ago, right?
Yes. And today we have very interesting stories saying that the Americans are shipping a THAAD radar battery kind of, missile deployment kind of thing to kind of make up for that. So what you have is very simple. If Israel and the Iran said that the time of strategic patience is finished. So if Israel strikes Iran,
which they've said they will do, right? I mean, they have said it.
Yes, within 24 hours, 48 hours, 36 hours, 1 week, very precise. So basically, they've said that. Iran has said that if you hit us, we're going to hit you immediately back. If that happens, Iran not only will hit, but basically, I believe that if the Houthis in their flip-flops can shut the Red Sea and bankrupt Eilat and Haifa, I think that I bet that the Iran can shut the Strait of Hormuz. So
if all of that was on the line, you would certainly think, as you indicated, prices would be a lot higher. So
but
the
we
market's
know
basically
that it's not
saying it's not going to happen.
So
right.
It's not going to happen. You're saying basically somebody's got a gun and he's putting it to his head. The West is putting that. If you do it, we're going to shoot. Who's got more to lose? The financial markets in the West will crumble, will dissipate overnight. There will never, ever be a recovery. Not in 10 years and not in 50. It's finished. It's absolutely finished. It reminds me of Dubai in 2008 when everybody was saying, oh, the crisis isn't going to hit Dubai. And then it's like a tsunami that comes and decimates everybody. So you've got to think these people are not stupid. And I guarantee you, when it comes to money, they're not stupid. When it comes to killing people and all this kind of stuff, fine. But now, when you're going to hurt them in their pocket, I'm telling you, the oil market does not believe for a second that they're going to do it. And if they do, kiss it all bye-bye. I mean, kiss it all bye-bye. Property prices, bond market, equity markets, the whole thing is absolutely going to tank. Everybody is going to sell. And you know how markets work now? Markets work with little phones, automated stuff.
Not pagers anymore.
Limit down, right? Limit down. So you're going to see like 10%, 20%, 30%, 40%, 50%, 60%. And it's never going to recover because there's so much debt it's never going to recover. Why is the S&P going higher if we think that there's going to be a war and Israel is going to retaliate and whatever? Because
Listen,
we
the
think
equity markets find everything bullish. It's no matter what the news is. Oh, that's bullish. The end of the world. That's bullish.
I'm telling you,
Buy
when,
Nvidia.
when it comes to money, nobody is stupid.
Briganka is going to talk about China teapots. Buy the equity markets. Briganka, with Iran situation, obviously the Chinese teapot refineries have been one of the major customers of this sort of so-called sanctioned Iranian oil. From the American point of view, this is oil that shouldn't be moving. Nonetheless, it's going to China in big numbers in recent years. What's the outlook there? What's the appetite for these teapot refiners? Always a little bit, vulnerable, always kind of looking over their shoulders a little bit.
Yeah. So actually, when we spoke with them last week, one of their main concerns was they were not too worried about attacks on Iran's oil infrastructure, because they were pretty sure that the US will convince Israel not to do that. But one of their concerns was tighter sanctions. So the US has been turning a blind eye. We've known in the last 2-3 years, China has been taking about 90%. These Chinese independent refiners have been taking 90% of Iran's crude exports. Iranian oil accounts for about over 50% of these independent refiners' crude basket. So one of their main concerns was tighter sanctions. Until now, what has been happening is, of course, they get this oil in the dark to Malaysian waters. It's transferred to other vessels. It's blended. It's rebranded as Malaysian origin oil, and that's how it shows up on China's doorstep. The US is very aware of it. They have been turning a blind eye to it. But one of the independent refiners' main concerns was that now the sanctions are going to get tighter. And that's exactly what we saw happen on Friday night, where the US has sanctioned some of these vessels that carry crude from Iran to China. So the independent refiners, because of the risks to Iran's oil infrastructure, Iranian oil loadings have anyways been dropping. So for these independent refiners, Iranian crude prices have been rising. Of course, now with tighter vessel availability, they expect more tightness of Iranian oil supplies, which means that they would have to look elsewhere. And where will they look? They will look towards Russian ESPO crude. So we're going to see a bit of a shift in trade flows, where they will start to reduce their reliance on Iranian oil and shift more towards Russian oil. But we don't expect
the other turned blind eye, where the sanctions are not being sort of enforced, if you like.
Exactly. So what we're not going to see a massive impact, simply because these refiners have been running at low run rates. They have limited crude import quotas. So we're not going to see a big impact where there's suddenly going to be this massive demand for ESPO. But what we will see is a gradual shift, especially if the situation lasts for very long and they find it increasingly difficult to ship the Iranian barrels, and the cost advantages that they've had for shipping these Iranian barrels start to sort of decline.
Well, it's as Omar said, you'd have to think that, putting everything else aside, if Mr. Trump returns to the White House and anything goes according to his previous term in office, Iranian oil was seriously targeted for shutdown. So that's only a few weeks away. Livia, I wanted to get the Energy Aspects view on the reporting in the last month, particularly noted by the FT article that indicated thinking of Saudi Arabia regarding the idea of a oil supply battle, a market share, call it what you will. And I know you guys have pretty strong insights on the Saudi oil policy. What was your take on that article? What it was talking about? Did it get much noise at your event in London last week? What's the Energy Aspects view on that idea of a possible OPEC plus market share war?
Yeah, of course. But if I may first, I just
Please.
wanted to react to something that was mentioned earlier
Yeah.
with regards to the sanctions on Iran and US turning a blind eye, because I think that's been a big focus in the market right now. And actually, just on Friday, the US government, I mean, announced a
Which
new
is the
set of
government, right?
sanctions.
You don't have to say the government.
Well, it depends where you're sitting in the world, right?
I don't think so, but perhaps.
Yeah. Anyway, they have announced some new sanctions and they are messaging it, and we've spoken to some officials directly on Friday. They're messaging it as a big expansion of the current package of sanctions. And I think it's important because one of the big assumptions of the market going into next year is that the status quo of pretty lax enforcement of sanctions on, say, Iran and Russia will remain so, and that is allowing a lot of extra supply to head into China and to some other markets. If that policy focus shifts and you get a bit more stronger sanctions enforcement, I think that will be material for the market. I just wanted to point it out.
Yeah.
But yeah, talking about OPEC, yes, there has been a lot of talk about a market share war and that possibly driving prices to very low levels. We and there were even, to be honest, some journalists and some articles in the media that were refuted by OPEC as reporting incorrect informations and referring to meetings that never happened, etc. So there is definitely a lot of misinformation and a lot of I would say even bias in the market.
Although they never denied the FT article. Saudi Arabia never came out and said that is wrong.
Yeah, I was referring to a Wall Street Journal article.
Right, yeah.
No, I think what is most important for OPEC, and always has been and always will be, is the outright levels of inventories, right? They are focused on keeping inventories from building and keeping them around the 5-year average levels. I think that's very important for them. They are not interested in starting a price war. They don't want to flood the market. We're not getting any sort of indication from them that is their intention. So, I mean, I think that's all there is to say to that. It really depends. Whatever they choose to do in, as regards to whether they'll bring back barrels by December time, which is the current plan for the moment, will depend on.
Which is in 6 weeks.
Yeah, I think they haven't made a decision yet. It will depend on whether inventories keep drawing, which, by the way, they have been, and we are still drawing in crude now. That typically is a period where we would be building stocks because it's peak refinery turnarounds globally. We're not seeing any meaningful stock builds in the big pricing centers. Yes, in the US they're starting a little bit, but on a global basis, inventories are still drawing, and I think that's very important to remember, especially when we come after 2 years in the global markets where we have failed to build inventories meaningfully. So we are at a pretty low level. And as we head into 2025, yes, the expectation, and that's our expectation too, is that we will build inventories overall. But we are starting from a very low base.
Let's go to the survey question, which sort of tackles some of the themes we were discussing this morning. My question, as it was earlier, what will have the biggest impact in determining oil prices over the duration of the fourth quarter? Inevitably, all of these are pulling and tug-of-warring a little bit, but which one do you think will have the biggest impact in determining oil prices over Q4? The China eco-stimulus, which continues to be, had a major impact on the financial markets in China. The equity markets in China have gone through the roof since they've started their stimulus program, but has kind of tapered off in its enthusiasm. OPEC supply policy, which, as was just noted, is due to start increasing from December 1st, which is, as I said, in 6 weeks. Or Mideast geopolitical tensions, which continue to rave in the background or in the foreground, and Omar's very strong point that there's no way they would attack Iran, given the sort of global economic fallout from that. So where do you think the biggest impact in determining oil prices over the fourth quarter will be? take your bets, please. Omar, I wanted to get your thoughts again on a more technical level. This was a market a month ago when the energy trading industry met in Singapore, and there was a notable the first ever net short, or basically the shorts had dominated the market, and since then, direction of travel. Your thoughts of where the technical structure of the market is and how that might indicate where it goes next.
So, okay, so the thing about looking at a technical chart is that you're not looking at, like, numbers. What the technical chart is showing you is market sentiment, or if you like, feeling. So when you get, the two greatest feelings in markets are fear and greed, right? And so basically the oil market is stuck between the two. But I think if you look at the upside can only be a strike on Iran. But strike on Iran means basically, financial markets collapse. It means basically there is no ground invasion of Iran. It's too big a country. So you're looking at, I don't know, maybe you're looking at like 100-year war. Who knows? And also Iran has nuclear weapons. So you've got to think that, not only will they invade, but Iran is going to hit with nuclear weapons. Israel is going to hit with nuclear weapons, but everything's going to be okay. So we take that off the table, which basically leaves the downside. So you've got basically the low, which happened in September on WTI, about $65. We'd need to see that taken out before we would kind of commit to the long side. But buying, WTI in the 70s or Brent around 80 or whatever is not for us. If we drop $10 a barrel from here, then yes. But again, we see the world as being inflationary. We don't see so we think everything goes up. It doesn't mean that the world or the G7 are getting richer. Doesn't mean that. It means basically that the currency is being debased and the number goes up just to kind of try and keep pace, but you're still losing real value, right? So you buy Apple at $100 and it goes to $110, but your actual $110 is now worth, in terms of purchasing power, 90. So we think markets are inflationary. So S&P goes up, eventually oil goes up, commodity markets go up, precious metals go up. But I think that is a function of inflation and the debasement of money, of fiat currency, basically the US dollar, than it is of any kind of, wealth building. And I think you've seen that for the last 100 years. So if you don't kind of believe it, then you have a real problem. So we think higher across the board.
Mriganka, where is the rest of Asia? Obviously, we talk all the time about China for all of the obvious reasons, and China's trouble at the moment, or trouble in a quotation marks. Ultimately, Goldman Sachs coming out today that they still see China growing at near 5% this year and somewhere a little lower next year, but still, from any global reference, that's a big number. But where does the rest of Asia, what's the sort of demand outlook there across the commodity spectrum, particularly energy, LNG and so forth? India doing well, still doing well. Your thoughts on the other part of the APAC region?
Yeah, absolutely. In fact, one of the most, despite all the geopolitical tensions going on in the Middle East, when we talk to Asian refiners, they don't seem so worried about that. What they're more concerned about is wider Asian demand. Gas oil cracks, for example, are down about $5 to $6 compared with last year. and they are seeing tepid demand, basically similar issues, right? Real estate, construction, manufacturing, all a bit on the weaker end in North Asia, especially. So if you're looking at Japan, you're looking at South Korea, demand has been fairly weak there. And they expect that to sort of continue going into Q4. So they're not very optimistic and add on higher shipping insurance costs, and their margins are dropping even further. So they're not super excited about the demand situation. They're watching it very warily. Of course, India is a growth story at the moment, so demand there is strong, especially the last couple of months because of the festive season. We have seen pretty strong numbers out of India. Coming to LNG again, because September is typically when people start buying LNG for the winter months, but because of a delayed winter, we've not seen that happen yet. Also, because we've had relatively mild winters the last 2 years, stocks are at very good levels in Asia and in Europe. So we're not expecting a lot of winter buying come in. There's nuclear restarts happening in Japan, in South Korea. There's more Russian gas flowing into China. So there's not that much demand for LNG going forward. But of course, there are swing factors. With nuclear restarts, there's always a risk that they get delayed. Weather is a big swing factor as well. So if there's really strong winter demand, then that could push LNG prices up as well. But so far, we are expecting no big spikes in LNG demand and LNG prices going into this winter season.
Livia, last word to you. Similarly, there we have a pretty split right across the three answers. So that's always good. All of the above, I suppose, people would have liked to have, but we'll put that on social media and see where it wins out in the day. But Livia, I wanted to get your thoughts as well, similarly in asking Riyanka there about Asia, non-China, Europe. You mentioned, Livia, in your earlier comments that it's important that the markets are not really pricing in the possibility of a return of tighter sanctions enforcement on Iran with a Trump presidency. Equally, a Trump presidency, if returns, I mean, it's as equal as the polls are indicating, neck and neck. This could go either direction. Omar said he's seeing some betting that's showing a 10-point lead for Trump. But ultimately, what does that mean for Europe and for Russia? Because all of the indications there are that opposite, tighter sanctions would come into Iran probably, but Russia would seem to get some wins with a Trump presidency in Europe. And so how is that being priced in or not? And how might it change or impact the flow of oil?
I don't think we really see a potential Trump presidency favoring, say, Russian flows or helping that in any way. I think there is a potential that a Republican government will become more stringent on sanctions than we currently are seeing, and that's across the board, really. It's about Iran, it's about Russia as well, and yeah, I mean, I as I mentioned before, I think that's one of the big things that the market is not necessarily pricing in at the moment. Russia is still exporting pretty much the same amount of crude that it did before the war started. Of course, trade flows have changed significantly, but India, China, Turkey all rely on huge amounts of crude from Russia. And should you see a little bit more enforcement on, say, which vessels are made available to transport the crude, and things like that, I think it could have an impact on markets for sure.
Well, we're going to have to wrap it up there. As we started out our conversation together, Brent crude oil was trading just below $78 a barrel, and Brent down over $1 this morning in Asian trade. We'll have to see if that continues with the opening of markets in Europe and the United States this Monday. But definitely a big tug of war between the geopolitical risk and other factors, obviously China stimulus and OPEC plus supply plans, what they are going to do. they're currently planning to increase production on the 1st of December. Will they follow through with that? Livia Gallerati, as always, wonderful to have you. Great to have Energy Aspects voice at our table. Priyanka Jayapuriar, and I'm going to learn how to say that properly for the next time.
Fine. You're actually
Thank
doing
you.
it really well.
Oh, really? Okay. Thank you so much. The name I do
Thank
know
you.
and can pronounce well is Omar Nadjaho. No, Omar Najia, we love you. Every Monday morning isn't the same without you. Thank you so much. Have a great week, everybody. Take care.
Thank you. Bye-bye.
Bye-bye.